It's Friday, February 21st, 2014. Time for Retail Now with RNG. This week, I'm joined by Max Ortwine and Logan Galogli of the analytics team, and we've got earnings releases from Safeway and Walmart, some big potential acquisitions in the U.S., new e-commerce data from the Census Bureau, and more this week on Retail Now. So joining me this week are Logan Galogli and Max Ortwine. Logan, thanks for joining us.
Hi Keith, it's good to be here.
Tell us a little bit about you.
So I've been with RetailNet Group for 2 years now. I started as a research analyst, and I currently work on our database tracking retailers' sales in stores.
Perfect. And Max?
I'm Max Ortwine. I've been here for about 7 months, taking it to the max. And I cover Walmart as well as several QSR retailers.
Perfect. So Max, the potentially biggest story this week is the earnings announcement by Walmart. What are some of the top line highlights?
Well, at the top line, they reported growth of 1.5% in their fourth quarter and 1.6% on the year. However, they struggled domestically. Comps were down 0.4% overall, including 0.5% down in Sam's Club and 0.7% down in the supercenters. That was driven largely by some cuts to SNAP benefits, which Walmart relies on for about $14 billion a year in sales, as well as some issues with weather, as the storms that have been sweeping across the country have kept a lot of people out of stores. Looking forward, Walmart will be focusing primarily on their small stores, as they've doubled their forecast from 150 stores to 300 over the next fiscal year.
And that doubling is since when? In other words, when was the most recent guidance they gave for small store opening plans?
The last update they gave was in October, so not so long ago.
Basically doubling the expansion plan within 6 months.
And they posted 4% comps growth in their neighborhood markets in this last year, so it's looking like those are doing quite well, and they're looking to drive growth through there.
Yeah, I'm sure there's some contribution from stores that are in the comp base because they're 12 months old, but they're still ramping up since they're under 5 years old. But there's no question Walmart has sort of tweaked and refined that format to be very capital efficient. It's performing relatively well based on these numbers and what we hear out in the industry. So it doesn't surprise me that they're doubling down on small stores.
Yes, and we should be updating our forecast in the next week or so. Some of that growth will likely come from the express stores and maybe even a few new on-campus stores, but the bulk of it is expected to come from the neighborhood markets.
So the other area Walmart's really doubling down on is e-commerce, right?
Yes.
And last year they hit $10 billion globally, which is a pretty impressive number in the context of e-commerce, still trailing pure players like Amazon pretty significantly, but they gave us some key updates for some of their big markets. They're targeting a $13 billion global e-commerce top line in 2013, which is another 30% increase compared to what was essentially a 30% year-over-year increase last year. And they've just added close to 90 click and collect locations in the UK, which is probably their most mature market. It's definitely their most mature market from an online grocery point of view, where they've got, I think, the second share in online grocery, and click and collect is really driving profitability, because naturally anytime you let shoppers do the work of getting groceries from the fulfillment center or store off to their house, you save a lot of money in fuel and labor for the drivers and everything else.
And they also added a few in tube stations, is that correct?
Yeah, they have a partnership with the London Tube, and I think it's only a handful, maybe 6. But the idea is in convenient locations on the way home from where people live or work, they can pick up groceries. So order maybe early morning, mid-morning, and then on your way home from work you can pick it up. I don't have any real sense about how that's performing, and my sense is, of all of the various locker programs and mobile shopping walls and subway stations and airports and those kind of places, it's been much more about driving awareness and perhaps triggering a download of a mobile app or something than it has been about actually converting sales or getting people to pick those orders up in a physical environment. You know, switching topics briefly from Walmart and Asda to Amazon, we know the Lockers program has faced some big headwinds. They've lost key accounts like Staples or key partners like Staples and Radio Shack, who did a 1-year trial in the Locker program, and it could have been just the intensity of co-opetition between those two. But we think it's also a relatively limited addressable market for those things. They're launching Brazil e-commerce in October, relaunching. They're already in business in Brazil online, but they're relaunching the site this October, which I think, based on other markets' performance, is likely to drive improvements in conversion rate. I'm sure they'll expand the category assortment. They also had fourth quarter year-over-year growth in Canada of 145%. So if you remember from some of the earlier episodes, Mary Sullivan and I have been spending a lot of time in Canada in 2014, and it really is because there's so much incredible growth in that market. As Walmart and Amazon and others are really starting to build out the infrastructure and the capability to respond to the demand that we know has been coming cross-border. We estimate over half of the total e-commerce volume in Canada comes from Canadians buying from U.S. online retailers. And I think finally the retailers are realizing they need to invest locally in Canada so that Canadians have more domestic options. So the Walmart Canada online number doesn't show me. And lastly, the investment in new fulfillment centers in the U.S. is really all about fundamentally trying to narrow the competitive gap with Prime, and that's primarily about delivery speed. And I think the delivery speed is also going to benefit from Walmart's flexible fulfillment initiatives around the stores, making in-store inventory transparent to online shoppers, enabling pickup today, enabling ship from store. Also trying to match Amazon on price or beat them on price. Walmart made a huge investment in price monitoring and price intelligence capabilities over the last 12 or 18 months. I do still think, as it relates to the competitive gap with Amazon, assortment is going to be the single biggest area where Walmart is challenged. I think they've been approaching a lot of manufacturers, asking for a larger catalog or a larger percentage of their catalog to list online. And candidly, that's something that is difficult to do without the fulfillment capacity that Amazon has. Dozens of facilities in the U.S., millions upon millions of square footage optimized for non-store orders. And secondly, what I think Amazon has learned is not everything they list is profitable. So on our Amazon Focus podcast, we talk a lot about some of the forthcoming programs on Amazon's path to profitability, like Amazon Pantry, the shift in Amazon Prime fees. And I worry a little bit that Walmart may bite off more than they can chew, asking for literally everything, and realize quickly they don't have the capacity and the economics can't really be supported. Max, there was a comment, as I recall, in Walmart's earnings release about minimum wage. Can you tell us anything about that?
Yeah, so there is talk in the White House of raising the minimum wage to $10.10 per hour, and Walmart is strongly considering supporting that move. They supported the last minimum wage hike in 2007 when it was raised to its current level, and basically for Walmart they have to balance the higher cost of their payroll, since they employ a large number of minimum wage workers, with the increased liquidity that would generate for their customers. And it's just going to boil down to the numbers for them. If they can make more with the minimum wage hike than they would lose in administrative costs, then they're going to support it.
Yeah, I think there's precedent with areas of legislation and regulation like healthcare in the U.S. where Walmart has actually taken a leadership stance based on their scale and their presence in the market. And I think this is another one of those instances where it's too early to call what they're going to do. But I think as I look at their huge investment in bringing manufacturing back to the U.S., you've probably seen some of the media investment they've done. This is another one of those potential policy areas where they could actually really benefit and align with some of their new positioning were they to head in this direction. But I agree fundamentally they're going to look at it pretty carefully, and there are ways to do well by doing good, and I think that principle is probably something Walmart understands pretty well.
I agree, and it's also worth noting that they were able to cut operating expenses in the last year, so even if it's only a return to previous levels, with the payroll increase, they have some wiggle room to work with.
Yeah, that operating expense decrease is a very big deal. I think most vendors we work with have experienced over the last 12 or 18 months that Walmart has fundamentally shifted and is much more balanced between growth and returns and efficiency. And so while they've brought some SKUs back into the assortment, they've also definitely been incredibly focused on turns and SKU velocity and minimizing labor required to move product from the back room to the shelf. So vendors are really starting to focus on labor efficient merchandising campaigns or merchandising programs, and I don't see that going away. In this growth constrained environment, there's just no question that Walmart will double down on small stores and online as sources of growth, but in their core big box business, efficiency and supply chain and operational excellence are going to be pretty important. And we've mentioned this a few times before, but if you really want to understand the details of these small stores, not only Walmart Express and Neighborhood Market, but the new Target Express format, Family Dollar and Dollar General, the chain drug players, convenience. Our colleague Hannah Donahue and I, a director of merchandising from 7-Eleven, the chief customer officer at Rudders, Aaron Rubenstein of Wolf Research, and others are all going to be in Dallas April 8th and 9th at our Small Store Summit. As far as we know, it's going to be the most thorough review of the formats, the business models, the growth outlook, and ultimately what vendors can do to win with these new formats that's ever been organized. So we'll put the link to the full agenda and registration page in the show notes for today. Logan, there was another big retailer with an earnings release this week and some other sort of bombshell news potentially there. Tell us about Safeway.
So Safeway reported fourth quarter results yesterday. It was kind of a mixed quarter for them. Sales were relatively flat versus last year, up just 0.2%. But comps were up 1.7% for the year, excluding fuel, which is one of the best comp results they've had since pre-recession days. Part of that is that they've exited a few markets that weren't profitable for them. That's had a positive impact on comps, but they saw that as a positive for their business going forward.
Yeah, I think about both these retailers. Safeway, fully committed to food. Walmart, very committed to food, but has a blended merchandise mix of general merchandise and food. And in the analysis we've done of what's really driving some of the growth in the food business broadly, and who's winning and losing, there's been so much intensifying competition. And it's candidly a huge part of why we're hosting this Small Store Summit in April, because when you look at all those channels and formats that we just mentioned, convenience, drug, discount, the big box players going small, just the availability of food and consumable products closer and closer to where people live and work, and at more and more competitive price points, has made it an incredibly intense competitive environment. So players like Safeway are doing a lot right, but it's challenging to outpace inflation and comp at a level that is above and beyond your direct competitors when there's so much new competition entering the market.
Yeah, they're really getting hit from all sides, kind of above and below.
Like a lot of people are. So there was another pretty important disclosure in that earnings release.
Yeah, so probably the biggest news to come out of the earnings release is that they announced right before the release that they were in discussions about a possible transaction regarding the sale of their company. They didn't discuss it any further in the earnings release transcript, but signs are increasingly pointing to Cerberus Capital Management being the company that will acquire Safeway. A deal obviously hasn't been signed, so it's possible that it won't happen, but that's speculation right now.
Yeah, I think it's way too early to comment on who, first whether or whom might acquire them. But whenever this kind of information hits the market, we always try to be thoughtful about imagining the scenarios.
Mm-hmm.
And there may be a private equity company that might take them over, in which case the motivation might be to really invest in management and try and grow that business profitably, or the motivation might be to cut expenses and close or sell underperforming assets,
Mm-hmm.
and really optimize for profitability. And then there's also the scenario that a competitor or somebody that looks more like Safeway themselves might buy them, somebody like
Mm-hmm.
Kroger.
Yep.
Do we have a sense for what that would look like, regardless of whether it's plausible at this stage?
Yeah, so we looked into a little bit, like what would the situation look like if it were Kroger who acquired Safeway. They would be, you're talking about the number 2 and the number 5 food retailer in the U.S., so it's 2 huge players. If they were to combine, their market share would be just below Walmart. Sales would be around 134 million annually. Billion annually. Walmart's at 333 billion, so significantly higher than them, but they would be really a player in the market.
And there is some pretty significant geographic overlap, especially in places like California,
Mm-hmm.
Colorado, and a few other important geographies. Do you have a sense for just how much of their footprints overlap?
Yeah, so Safeway has over 500 stores in California, and Kroger has a big chunk of its store base there as well. So they'd overlap pretty significantly, especially in Southern California. If there were to be a deal, it might involve some divestitures by the company just for antitrust reasons. But it would be a dominant player in the western United States.
Yeah. Well, I admire that Safeway continues to execute amidst all of this uncertainty and some of the competitive pressure in the marketplace.
Mm-hmm.
And they also have some initiatives that they're still working on that they
Mm-hmm.
talked about. What are some of those?
Yep. So they continue to focus on store level initiatives. The main ones are personalization, store clustering initiatives, which is targeting different types of stores to the neighborhood that they're located in. So they have their premium version of their store, which has merchandise that's different from its value store, and they do a lot of region by region analysis and research on what store will do best in the neighborhood that it's in. And then last thing is personalization with the Just For You loyalty card. Is still a huge initiative for them.
Well, we'll definitely be following it closely and keep everybody posted if there's any major developments.
Mm-hmm.
And speaking of possible sales, wasn't there another story that just broke within the last few hours about Barnes & Noble?
Yeah, so another possible private equity takeover, G Asset Management announced that they put in an offer to acquire 51% of the shares of Barnes & Noble. They're offering a price of $22 a share. Barnes & Noble shares spiked right after the announcement, but they've since dropped a little bit. So the market's still watching.
And have they said anything about their plans for Barnes & Noble's digital business as it relates to the brick and mortar business?
Yeah, so that was a big part of their push to acquire the company. They want to acquire Nook as well. And if they were to acquire both parts of the company, they would spin Nook off into its own separate entity, which is something that Barnes & Noble themselves had talked about doing earlier in the year and then decided against it.
I remember Microsoft was mentioned as a potential acquirer of the Nook business at one point too, and I know they were an investor.
Yeah.
That side of the business just seems like it was performing relatively well, but as is often the case at these big mature businesses
Mm-hmm.
with really asset intensive brick and mortar retail arms,
Mm-hmm.
it was not big enough despite its fast growth to move the needle on the overall business.
Mhm.
And so it starts diverting capital from the core, gets viewed as a distraction, and it never got the critical velocity that it needed
Mm-hmm.
to establish Nook as a really compelling, not only device and marketplace to compete on even footing with the Kindle.
Mhm.
And so
Right.
Amazon has basically locked down the ebook marketplace. Not only Barnes and Noble, but iBooks from Apple is
Mhm.
really struggling.
Yeah.
So
It's a tough business.
yeah, I think it'll be instructive to see what happens with Barnes and Noble, because we've watched all these category specialists over the last decade, booksellers, toys, electronics, go from maybe 3 players down to 2 home goods. They go down to 2 or potentially 1.
Mm-hmm.
So we saw in electronics Circuit City and CompUSA went away. In home goods, we lost Linens and Things. In toy, we lost KB. And so you sort of have this last man standing effect. And in book selling, there's the last man standing on the chain side, and then there's also a long tail of independents. And I think this is one of the bellwether segments of the industry from a structure point of view as it relates to categories that are really migrating to the web, either directly through digital substitutes or from people simply preferring to buy the physical product online.
Mm-hmm.
Well, speaking of e-commerce, there was a lot of new data that came from the Census Bureau this week.
Mm-hmm.
And candidly, I didn't find most of it surprising. You know, the run rate of e-commerce at a 3 to 4x multiple of brick and mortar retailing held true for 2013 in total. So e-commerce grew at 16.9% for the full year versus 4.2% for brick and mortar. So that's consistent with what we've seen for the last 3 years, basically low to mid single digits for brick and mortar, high double digits for e-commerce. And in the fourth quarter, what really surprised me was that e-commerce had a 7% share of all retail versus just a 5.2% for the full year in 2012 and 5.8% in 2013. So during that fourth quarter, online basically gained almost 1.5 share points versus brick and mortar. And I think if you look at what Amazon in particular, but others did to really promote and try to acquire customers during the fourth quarter. You know, we talked on a previous episode of Amazon in Focus. Amazon was advertising Prime on television aggressively, which is something that's pretty unprecedented for them. They were offering free 30-day trial memberships to Prime, really oriented around gifting. In other words, solve all of your wish list issues with free 2-day shipping, plus the value-added gift wrapping they offer for $3 or $4. Anyway, it's significant that this really critical holiday period is increasingly disproportionately won by e-commerce relative to how e-commerce performs the rest of the year. And it's going to be really interesting, I think, to watch how Amazon or anybody else that acquired some new customers during the fourth quarter and the holiday season end up maintaining some of those customers.
So do you view that higher share as sustainable going into the new year, or do you think it's going to see a drop that is then regained in the fourth quarter of 2014?
I think there's always going to be some fall off. You know, what typically attracts these customers is they're buying discretionary $20 plus items for a very specific occasion. But I think what happens to many people, and I can't give you a hard number for the retention rate of these Prime trials as an example, but I bet it's over 50%. People try it for 30 days to buy something for their wife or their cousin or their nephew, and when they see how easy it is and how price competitive it is, they let that trial lapse into a fully paid membership. And if that happens, they're really naturally incentivized psychologically to try and get more value out of that sunk cost. So the $79 has already been billed to my credit card, and now I need to get value for that investment, even though it was sort of accidental because I signed up in December to buy my wife a present. And so I think it's not going to maintain that elevated 7% share of all retail may not be maintained throughout the calendar year, but I bet it definitely accelerates the share shift by a couple 10 or a couple dozen basis points during the fourth quarter, and I think it's likely to continue that way.
Mm-hmm.
So those are the major topics we had this week. I do want to let our audience know, we had a client ask us this week whether we accept audience-submitted topics for discussion, and we absolutely do. We love your feedback, and we definitely want to hear from you. You can email our entire analyst team at analyst@retailnetgroup.com. You can follow us on Twitter at @retailnetgroup, or me personally at Keith_RNG. Are either of you on Twitter?
Not yet.
Well, send an email
I'm following you on Twitter.
Send an email to analyst@retailnetgroup.com and let both Max and Logan know they need to get with it and get on Twitter. But we absolutely welcome your input on what we should cover. So whether it's just a theme or a specific question, please let us know. And I'm sure we have a lot coming up next week. Logan, what's next?
So another big week next week in terms of earnings. We have Home Depot, Lowe's, Best Buy, and Target reporting their fourth quarter earnings next week. So we'll be updating our forecast for all of them. We'll be publishing on all of them, so look forward to that on rng.com.
Max?
I'm going to be spending the bulk of my week updating Walmart's forecast to reflect some of these new changes and announcements that they've made. So that hopefully will also be on rng.com by the end of the week as well.
Awesome. And I'm doing a lot of work around Amazon at the moment. There's at least 5 major developments underway, all of which you can hear us cover on Amazon in Focus. But Amazon Fresh is potentially expanding internationally. News broke just this week about Germany being potentially the first international market for expansion. It's starting to look like this long speculated set-top box for streaming video and potentially gaming might launch as early as March. And Amazon Pantry, which the mainstream press published on maybe 8 weeks ago, is also rumored to be launching sometime over the next several weeks. So those are just a few of the topics that we're focused on, but lots to come. We appreciate everybody joining us. Have a great weekend, and we'll see you next time.